markets take a little bit of a breather on Monday after last week's brutal bloodletting. Are they going to find their way to yet another bounce, or are we looking at something that is more painful yet to come? That's the question we're going to wrestle with here today on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we are going to do here is take a look at what happened last week, just briefly to anchor ourselves in the backdrop, and then consider what comes next. And shock of shocks, it's all about inflation and what it means for interest rates. Some big data coming across the wires this week, not only out of the U.S., but also elsewhere. So let's take a look at first what last week was all about. We can see here stocks having a nasty one. S&P down 2.1%, NASDAQ down 2.3%. Surging interest rates across the curve, and the curve steepening actually as the long end outperforms. The 10-year up 3.5%, the 2-year rate up 2.3%. So higher interest rates all around, but the front end having a smaller move than the back end, and so the curve growing steeper. Crude oil seemingly of its own mind, still up 3.5% after the prior week's 4.8% rise. Of course, it's a little stronger again here today. Unlike gold, which managed, despite rising yields, which typically amounts to kryptonite for gold since it yields nothing, still managing a little bit of an upturn last week, up 2.3%, but it is now very much giving away a lot of those gains just at the start of the week. The dollar stronger against the euro, stronger against the yen. But interestingly, the yen actually holds up much better once we get to the end of the week last week. It's down on the week on the whole, but the overall story is much more supportive as that risk aversion bites on Friday. Bitcoin certainly looking like an amplified version of that risk aversion, which basically gives it double the loss of the S&P. And the weakness here is very easily traceable to two pieces of economic data, which ultimately tell us the Fed is not going to cut rates as much as markets might have hoped. We get in the middle of the week the ISM services report that covers the lion's share of what drives growth for the U.S. economy, and those numbers are white hot. The rebound in overall activity sharper than expected, but the real standout is the jump in the prices component. That, of course, is where inflation lives in the U.S. at this point. It's all locked up in the service sector, as we'll see momentarily. And that ISM services report gives us a story that suggests that service sector inflation isn't going very far except to keep pushing higher. Because what we end up with there is the strongest price growth reading since February of 2023. And so the markets look at that and say, okay, well, this is not exactly an environment in which the Fed can cut rates. We then, on Friday, after a brief break midweek for the market holiday linked to Jimmy Carter's funeral, former U.S. President Jimmy Carter, of course, we then get the U.S. jobs report, and there we end up with stronger results. 256,000 jobs added against expectations for 160. So we beat by almost 100,000 jobs. The unemployment rate unexpectedly comes down from 4.2 to 4.1%. And then at the same time, we get a solid number set for consumer confidence from the University of Michigan. Interesting bit there. Again, inflation expectations. The 1 year forward inflation forecast from consumers polled for that survey up to 3.3%, the highest since May of last year, unexpectedly, from just 2.8%. So inflation expectations surging all around, that diluting how much the Fed could possibly be seen to cut this year. And of course, against that backdrop, yields rise. What's interesting here is that whereas at the tail end of last year, we were getting interest rates rising, and indeed, we've seen this story develop since mid-September. We talked about this at length. Here's the bottom in interest rate expectations, or as it were, the most dovish setting, the most number of rate cuts being expected over this year and next. That's mid-September when the Fed makes its move to actually begin cutting rates. We can see they shortly after this bottom start their easing cycle. And as they do, and the economy appears to be hotter than expected, the markets say, okay, well, you're cutting into an economy that doesn't so much need stimulus. What you're going to end up with is reflation, and you're going to end up having to do fewer cuts in 2025 and 2026. So we see this tally diminish. And of course, now we're looking at just 46 basis points in all. One cut now baked in for this year, another one all but expected for next year. And here, by the way, is last week's pop in these expectations. So from here to here, and that's the influence of that hot economic data. So the market's now looking at all of this. They've, of course, been doing this process for a while, but last week it got more juice. And whereas stocks were moving to record highs, at least, let's say, September, October, November, as this process was occurring, last week, the first full week of 2025, we very clearly saw not that. So it seems like yields have gotten to a level of pain where now higher economic data doesn't necessarily mean good news, because now the markets aren't looking at that and saying, oh, goody, the economy is growing faster. Now they're looking at it and saying, oh, no, rates will be higher, and we don't need the cost of money higher this year. So this is where we find ourselves. And if we look at how these rate cuts are expected to work themselves out here, we can see the median rate 4.38 now. And if we follow along to what would look like a rate cut from this level, essentially the underside here is 4.25. 4.38 is a median that exists between the current setting of Fed policy, 4.25 to 4.5. And if we subtract from it one rate cut, that gives us 4.13. So we end up with one cut somewhere in the early second half of the year. So July, September, somewhere. And that's what we have for the year. Notice the terminal rate now north of 4%, whereas in September, when the Fed started the easing cycle, that would be here. Of course, we saw this adjustment that matches up with this adjustment here. We were looking sub 3. That's the backdrop. Now, what of this week? Well, we're going to get the relevant data here, needless to say, by way of the CPI report. This will be December's numbers. And as we were saying earlier, we can see that all of inflation, for the most part, now lives in core services. That's services minus energy and food. We can see goods inflation still slightly negative here. Energy inflation, likewise negative. They're actually deflationary forces here. And Food inflation is basically a negligible contributor at this point. If we look at what this actually amounts to in practical terms here, of the 2.7% headline inflation recorded in November, 2.64 percentage points was services. Energy was a negative 21 basis point influence. Goods was a negative 12 basis point influence. Food a positive 30 basis point influence. So it really is all about services here. And needless to say, what we've learned last week is that were these numbers to be hotter, the markets now seem to think this is bad news, because that would mean that the Fed is pressured even further to dilute rate cut expectations. And so with that hot ISM number conveniently out last week, we take a look at how service sector inflation dynamics have played so far. And we can see that service sector prices component, that's this right here. Here's that surge to the highest level since February of 2023. You can see that right here. And you can see that both the headline measures of inflation in the US, CPI and the PCE index, lagged about 2 months to this ISM prices component, lines up quite well. And so what that ISM prices component seems to anticipate then is we are now biased higher on prices, and CPI is about 2 months behind. And so the next step is at least somewhat tipped to be pointing upward. And so this narrow reflation that we've started to see here, probably not over, taking this at face value. Moreover, the direction of U.S. economic data relative to forecasts seems to have shifted after undergoing something of a correction. From mid-November, we can see the data started to cool relative to forecasts, looking at this index from Citigroup that measures relative performance. But now, with last week's NFP numbers, with last week's ISM numbers, we've once again seemingly started to reaccelerate and tellingly moved through the 20-day moving average on this. Now, as we've explained before, we're not doing technical analysis on an economic index. What we're doing is looking at a monthly average, and there's about 20 days in a month of this data, 5 working days a week, 4 weeks, give or take. And economic data tends to be released on a monthly cycle, most of it. Some of it is quarterly, some of it is weekly, but most important economic data is released monthly. And so when you go through the monthly average here, you get the sense that there's been enough data released for the monthly cycle to tell analysts your models are wrong, you need to update them. And if you see this kind of thing, that might very well inspire that model revision. We've seen that when you move through that moving average, be it here or here or here or here or here or there, you tend to see points of follow through. Not always. Sometimes you get false starts, but you do get a sense that perhaps now U.S. economic data is once again entering a cycle where it's going to be outperforming relative to expectations. Along with the ISM foreshadowing here, that may set the stage for hotter CPI. And of course, were that to happen, we probably get more of an upswell in yields, and that probably doesn't sit well with stock markets if last week is any indication. It's the same story when we get to U.S. retail sales data. That's due on Thursday. Expectation is for a 0.5% rise, and that would be a slight down step from the 0.7% in the prior month. But again, the risk here is, at least for stock markets, that the numbers come out hotter. That further emboldens hawkish, speculative forces in rates markets and ultimately hurts stocks. Shifting focus across the Atlantic, the UK gives us the other big narrative for this week. They are also reporting inflation data. Here we're looking to remain unchanged at the headline, 2.6%, which is a three-month high for a second consecutive month, but the core reading just a touch lower, from 3.5 down to 3.4%. It's a bit of a different story here, though, in the sense that where U.S. economic data seems to have marked a little bit of an upturn relative to expectations, in the U.K., you're still very much underwater. This is the U.K. Surprise Index, and you can see here's the zero line where forecasts and realized results are in agreement, and we're well below that here, deeply into negative territory, suggesting that the surprise risk here is tilted to the downside. Now, because the U.S. and the Fed are such heavy weights in setting global interest rates, we can see that just as the situation in the U.S. corrected to a higher rate structure, so too the situation in the U.K. shifted. You can see again from about the middle of September, where we had the most dovish outlook, 173 basis points in cuts, we've now shifted to about 50, and that's over the course of this year and next, although you can see for next year, the forecast currently calls for essentially no action. All of that 50 basis points here almost is being baked out for 2025. But as we can see here, the turn is very much in line with this turn that you see on the U.S. side. And it's because the Fed is the steward of the U.S. dollar, and according to the Bank of International Settlements, close to 80% plus of global monetary transactions are settled in dollars. So much so that even when, let's say, two countries want to transact bilaterally, it is actually cheaper to transact from one currency into the dollar and from the dollar into the third currency, because the dollar is so liquid that the transaction costs are lower. So overwhelmingly, the dollar settles global monetary transaction volumes, let's put it that way, and is the premier vehicle for getting economic activity settled. So when you get a rise in the cost of borrowing dollars, as is implied by this shift in the Fed outlook, you likewise get knock-on effects everywhere else. In the UK, this has come alongside with their own sort of upswing in inflation over recent months. But of course, that has clashed with an economy that seems to be cooling. The recent PMI data suggesting that growth in the UK is coming down. And indeed, we'll see what the monthly GDP indicator gives us this go round. It is on the menu for this week, and it is expected to show us, at least in relative terms, what we might expect downwind from the more important quarterly numbers. The expectation here that we are going to end up with a 3-month GDP growth average at 0.1%, but in month-on-month terms, at least, that we are going to return to growth, that output is going to expand for November at 0.2%. That's after 2 months of 0.1% declines in September and October. So maybe a slight bit of positive news. But given the way this is set up now and the shift that's occurred in the rate structures, we can see this looks almost identical to what we see from the U.S. Here's the structure in the U.S. September's curve already by November, by early November, giving us a much more hawkish reading as the markets interpret the Fed to be too dovish for the economy. And something very similar, of course, happening in the UK. Here we've gone from 3.4 as the terminal rate for the year to now 4.25. So if we take a look at what the 50 basis points that are implied here would look like, we go from 4.75 first here to about 4.5. So we get one cut somewhere in the first half. We can see it's loosely being baked in by March here. And then the next one to 4.25 gets stretched all the way out until the end of the year. And maybe you arrive there almost about 3 basis points shy. Indeed, it's exactly 3 because, as you can see here, this is 47 and not 50. So the risk here becomes if the CPI data, and indeed to some extent the GDP data, comes in softer than expected in line with this, then you have some rethinking to do on just how much easing the Bank of England might be doing. And this tally might push out further. Now, where this becomes interesting is, of course, for the British pound. It's a question of how much lower does it go, and does this surprise significantly to push it lower still? Because, of course, the pound has been absolutely trashed in recent weeks. It's come down very, very sharply, and just over the past 24 hours, touched the lowest level since late October 2023. It's also sitting on significant lows from right around then. The October 2023 congestion range was a big area of bottoming for the pound after a very significant sell-off from July of that year. Since then, the pound rallied all the way through September of 2024, basically a year's worth of gains, until this rethink on U.S. rates that we've just looked at and that we're currently looking at in indirect form in UK futures started to really drive the dollar up right alongside yields. So if we're going to see some sort of a response here, some sort of restructuring of the outlook to a more dovish setting, the really interesting thing here would be whether the pound signals that this has already been anticipated and rallies despite the reshuffle. In other words, if this curve starts to move lower here and the pound doesn't fall further, there could be a very compelling bottom starting to take shape there. And that is Macro Money for today. As ever, we are here every Monday through Thursday, right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, that's tomorrow, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're checking us out on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.